Money. Money.
During Morning Chat, sometimes I bring in my arena, which is mortgages, and sometimes I bring in other information. But today I'm going to talk about mortgages, or I'm going to talk about mortgage insurance removal. With all of the equity, the appreciation that we're seeing in homes, with the massive appreciation that we're seeing in our local real estate market here, if you have a mortgage and you might be thinking about removing your mortgage insurance, or look at what your options are. If you're looking at purchasing a home and going in with a lower than a 20% down payment, being educated on how mortgage insurance works as far as removal is important. So I want to go through that today on Money Chat. It depends on the loan and how you can remove the mortgage insurance. Mortgage insurance premium, or MIP, is for FHA financing, is required for the life of the loan. Private mortgage insurance, or PMI, is for conventional financing and can be removed. The Homeowners Protection Act law governs when mortgage lenders can and must remove mortgage insurance for a home. So I want to go through those options. Now, lender mortgage insurance, also known as private mortgage insurance, or PMI, in the U.S., is an insurance payable to the lender to trustee a pool of securities that may be required when taking out a mortgage loan. It is insured to offset the loss in case a consumer is not able to repay the loan and the lender is not able to recover its cost after foreclosure and the sale of the mortgage property. PMI is required, again, on a conventional loan if you're doing less than a 20% down payment. So automatic PMI termination. Once your loan to value based on the original price you paid for your home is 78%, the PMI will automatically terminate if your payments are up to date. Next is to request the PMI removal. You can request removal of PMI when the loan balance reaches 80% of the original home value when the loan is initially taken out. Now, PMI disclosure will be part of the disclosure package and lists the date when you will hit that 80% mark. Extra principal payments during the time can shorten the time to reach the 80%. And to have PMI removed, you must be current on your mortgage payments and request the PMI removal in writing. Now, the lender may require for you to prove that there is not a second loan on the home and make you pay for the appraisal to show that the home value has not decreased. This extra 2% on the loan to value from 80% to the 78%, where it automatically is removed, is extra money out of your pocket. So mark your calendar for when your loan reaches that 80% loan to value from the original price you paid for the property. Because on a $100,000 loan with an estimated 0.78% calculation for the cost of mortgage insurance, where it will automatically be removed, this would be an additional $65 a month you would pay from the time that you were at the 80% loan to value, but didn't know that the mortgage insurance didn't automatically drop off until the 78% loan to value. So based on today's interest rates, you would hit that 80% target in about a year, costing you over $700 if you miss that opportunity and wait to the 78 when it automatically just drops off. Now, also, there's an alternative termination criteria. The Homeowners Protection Act dictates that the PMI can stay on the loan for no longer than 1/2 of the term of the loan. Even if the loan to value is greater than 78%, when half of the term has passed, the lender must remove the mortgage insurance. This final termination of PMI might occur with mortgage terms that include interest-only payment period. We're not seeing a lot of those now. But when the loan balances has not reached or reduced the monthly payments. Now, the last option for removing your PMI is request early PMI removal. You can request early removal of PMI when the loan balance reaches 80% of the home's current market value. In addition, you must have a minimum history of making payments on a loan for 36 months with no delinquent activity. To have the PMI removed early, you must request the PMI removal in writing. The lender may require you prove that there is not a second loan again to make sure that there's no additional mortgages against it. And they'll definitely have you pay for the cost of the appraisal to show that the current market value and where your loan balance at supports that 80% loan to value. Now, there are many ways to avoid paying PMI. You've heard me bring this in at Money Chat before, where you can do a lower than a 20% down payment. There's lender paid options where you're going to take a higher interest rate. You would never do that unless you're going to keep the mortgage very short term. There's also the single premium, or known as a buyout. That's where you're going to pay an upfront fee to completely buy out the mortgage insurance. My favorite, if you're going to be holding on to the mortgage, it's a really great option. You can actually finance into that loan as well. And you'll definitely have that recovered. The cost of that less than the minimum requirement to hold on to the monthly mortgage insurance, asking for that early removal, especially when you have to pay for the cost of the appraisal. I will let you know in this market that it can be a little challenging in our local market here to get your offer accepted when you're doing paying less than a 20% down payment just because of the competitiveness of the market. But if you don't have other options, there are alternatives to get creative with that PMI. So that's my money chat for today. Coming up next on the Money Hour, the market is insane. Tell me what's going on. I'm sure a lot of my listeners are asking that. That's why I brought in these guests, Maya Butler and Rosemary West with Real Logic Sotheby's International Realty right here at 1150 AM KKNW after this short break.